Good evening and welcome to our September edition of the Economy, Market and Investments Outlook. Uh, I will, over the next 45 minutes, be covering our views on the world economy and the Indian economy and the implications for the markets. Uh, so let me start by focusing first on a brief snapshot of the world economy. And as you can see from the subtext here, right, world economy is actually started riding the recovery post the COVID. This recovery in this table, which is the IMF's data, will show you that it's for calendar years. So when we talk about the world, we always talk calendar year because only India and a few countries follow the financial year, April to March. So the global growth, right, in 2020, thanks to COVID, was a negative 3.2%, right? The only country which even last year showed a positive was China with 2.3, right? Now, why did China show a positive when the whole world was negative? Because China got the thing in 2019 itself. So by the time 2020 came in, they were on a recovery path from the COVID already, right? So overall, from a negative 3.2, 2021, which has just a few more months to go, is going to show a sharp bounce back to 6%. Bear in mind that these are YOY numbers, that is year on year. So the bad -3 degrowth of the previous year has helped the 6.1 number look at what it is. The genuine growth is obviously got to be looked at from a base effect perspective. But still, the 6.1 tells you that the world has bounced back and all regions across the world are in positive territory, right? Now, here you can notice that in the bounce back, India, which fell the most because we got a severe lockdown, which is a choice by the government to introduce a severe lockdown, that we had a -7% growth in the last calendar year. And so our bounce back is also sharpest at 9.3 for this year. But as you all know, markets look forward, and it's the next year which is of concern to anybody who's making an investment decision today. And there, when you see the world is expected to grow at 4.6, which is a pretty good number because you're coming on the base of a positive growth of 6.1. So that's a good recovery. The second thing is every country is positive. That's why it's a synchronous recovery. And here, the interesting thing to note that India will continue to be the fastest growing region at 7% growth for the next calendar year, right? So with that in mind, the takeaway from this slide is that a recovery across all parts of the world is on the way. Yes, it's not going to be a smooth recovery. There is the Delta variant, which has gotten affected. There is also the fact that the vaccination has hit a kind of a level in the US, and the cases are also hitting a plateau. So these factors will be there. But overall, the world is also much smarter, having learned from the first lockdown that they shouldn't hurt the economy so much. So it will be a well-managed process, and hence a synchronous recovery can be expected, right? Now, when you look at it, right, the key element here is that demand always bounces back because most Western countries are demand driven. In a lockdown COVID scenario, the demand falls and the pent-up demand comes back. But what is interesting is that this time the COVID crisis actually caused a supply shock. As you know, semiconductors are one. A lot of areas, because people couldn't go to work, there was a supply shock. And hence the recovery this time in the real investments, which is the supply side investments, right? If you see there, various financial crises over the last 40, 50 years have been demonstrated in various colors. The yellow one is to be noted because the biggest crisis in recent times, the global financial crisis. It took 38 quarters for the real investment, supply side investments to bounce back to pre-recession period. Whereas the dark blue line that you see indicates that this time within 12 quarters, right, you will be able to get back to supply side investment to pre-recession periods. So one of the sharpest pickup post-recession compared to previous recessions, right? That's the beauty of this crisis, that it was very sharp, but it was very sudden, but the bounce back is also sharp and also sudden, right? And what is the important feature in this global thing is the US, which is still the largest mind share market in the world, right? The capex cycle bounce back is the strongest since the 1940s. Why am I focusing on the supply side? Because demand side products, right? It's a production which just satisfies it. But in supply side, you need capacity creation. As you all know from my past webinars, right? A revenue expenditure multiplier effect and a capital expenditure multiplier. So very, very different. Capital expenditure lasts for 3 to 4 years in terms of the multiplier effect. And the reason I say this is the US capex cycle ultimately has to be fed by exports from Asia, right? So when I say this, to prove that point, I've got here a data of two graphs. One graph is yellow, one is blue, right? What is the yellow graph? It is Asia excluding Japan. AXJ means Asia. Why are we excluding Japan? Because Japan is a developed country, right? So if you look at the developing economies of Asia and look at their good exports, and then look at the US's good imports, you can see the strong correlation, right? So that's what the back up the statement I made, that any development in the US has to be financed by exports from the Asian emerging countries. And the good news is that because this demand is on the supply side and something on the demand side, you need to create fresh capacity to make these exports. So now what I've done here is I've taken the emerging market real exports, which is the blue line, and I've shown the emerging market fixed capital formation, which is capacity creation. As you can see, even exports for it to be done needs capacity to be created. So why I'm saying this time the recovery in the world is going to mean a capex recovery across emerging countries in order to be able to export to those countries. So that's the beauty, that this recovery is expected to be a multi-year with a strong multiplier effect. So that's the confidence, and that's why it's reflecting in the equity markets in some form, right? So that was a quick snapshot of the world situation. Now let's focus more on India, because as we all know, India is the country for which we will derive most of our investment income from. So India also, the story is the same. We are also riding the recovery path, right? In the case of India, let's just look at the COVID situation first. So if you now look at it, right, in terms of infections and deaths, this is a 7-day moving average. So it's a flattened curve. So if you look at it, infections and deaths, both after peaking in the second wave, have dropped and have plateaued, right? So this gives good news to us that the worst of the second wave is behind us and we are now stabilizing. There is risk of a third wave, right? So how to control the third wave? The only tool at our end today is a vaccine. We don't have a cure for COVID yet. So what does a vaccine do? It doesn't prevent people from getting COVID. What it does is the COVID that you get will be much milder. So the chances of you going to hospital are that much less, and the chances of you dying are very much less. That is important because now then COVID will come. If you vaccinate most of your population, you will then treat COVID like a very severe flu and say, okay, you're going to take 2 weeks, 3 weeks off from work, but you'll come back. So the need for a government to put a lockdown to do all of that will dramatically come down. So this vaccination trend, right? So what is the current state? If you take the adult population, today we have achieved 53%, more than half of our adult population has got at least one dose, and about 16% have got both the doses. So which means half of our population is already protected from a severe COVID, right? What is the way forward from this half? The way forward is that today, I've drawn multiple scenarios here, that we are sitting with 5 or 6 vaccine approvals. We are sitting in a very surplus vaccine situation, right? Now it's only the vaccine hesitancy that we need to target in order to make sure that people get vaccination. The supply is not an issue. And the clue for that comes from the fact you would have seen the announcement, government had decided to allow export of vaccines again, which means we have much more than we need. So provided we combat this whole hesitancy in vaccination in some parts of the population, we should see at the current rate of vaccination, definitely by the end of the year, we should have 100% of the adult population one dose at least, and in another 4 months, we should have 100% having both the doses. This 100% can be achieved if only the mental block that some people have against vaccination removed. Supply of the vaccine is not an issue. So this will moderate a third wave. In fact, to the extent that we internally have stopped calling this the third wave as a possibility, we are calling it a third ripple, because that's how soft the effect is going to be with the vaccination success story. And over and above the vaccination story, there's another interesting thing which I have not put a slide on, which is called the seropositivity. What is seropositivity? It is the antibodies that are there in the human body to combat COVID. Now you'll say if somebody didn't get COVID, he still had antibodies for COVID. How come? That is because he was a silent carrier. And two, the symptoms were so mild that they mistook it for flu, never tested for COVID, and this disease went off. But they got the resistance within them. So the seropositivity rate in India is at 64.5%, which is all those parts of the population already had of COVID. So that's again a very positive signal. So all in all, we are very sanguine of the impact of a third wave, which at all it happens, the likelihood is around the festival Diwali season, because as you see in Kerala, during the Onam festival is when we saw a major spike. So similarly, Ganesh Chaturthi is one now, and then you have these are probably the factors where you could see a rapid spread of the COVID, but because of the seropositivity and the vaccination percentage, we believe that the impact will be less on the economy. So now we move away from COVID to see what happened in the second wave and how is the recovery happening. So we have chosen first the mobility indicators. This is called the Google mobility indicators. And what we have shown here is the drop in the second wave of various types of mobility. So retail mobility and recreational mobility, mobility in parks, mobility to in workplaces, grocery and stores, transit stations, and residential. As you can see from the green line, in the case of residential, there wasn't a drop. Residential mobility was right through there. But all other mobilities took a beating in the second wave, and you've seen all have shown a sharp bounce back. That's number one. Number two is on the manufacturing side, right, and the services side. The PMI saw a sharp drop, obviously, last year. And again, during the second wave, you saw a drop below 50. The drop was not much to a level of 40s, but happy to report that now both the manufacturing and the services PMI are trending above 50. So when it's below 50, we are talking about a contracting economy. When it's above 50, we're talking about an expanding economy. So the PMI indicators are indicating that India is expanding GDP more, right? And the spillover effect is there on unemployment, naturally, because these are supply side factors. And there where you can see, right, most recently in the second wave, there was a drop, rise in the unemployment. Can you see that spike up? And that has now tapered down. So both rural and urban employment is stabilizing post the second wave. Again, a good indicator. The third way to look at this is in terms of e-way bills. The government, as you know, has shifted completely to e-way bills in terms of its purchasing. And there, when you can see now that the second wave drop has now resulted in a sharp V-shaped rise in the e-way bill numbers also. So overall, on the economy, Nomura does a business resumption index, and this they've taken at 100 pre-COVID, dropped to 45 in the first wave, dropped to 60 in the second wave. But post that, we are now back at 100 plus, which means we are back to pre-COVID levels and slightly better. So again, auguring well for an economic growth story, right? So on the GDP front, then quarter on quarter, right? This first quarter, April, May, June, 20% is because the same period last year was minus 20%. The third quarter, again, we are likely to see a jump because of the base effect. So overall, adding up the 4 quarters for the current year, we believe that RBI's growth expectation of 9.5% is more or less on track, even with a third wave coming through. But that being said, there are 3 risk factors or positive factors as you think about it to be considered. One is how strong is the festival season. So the COVID rears its ugly head in the second wave. If it doesn't, there will be a strong festival season to boost GDP. Next is how the third wave itself plays out. And third is globally, I told you about the semiconductor shortage. So the supply shortage, right? How far that's going to get normalized will also determine how fast Indian economy recovers, right? So stepping away from the broad economic indicators, let's look at one of the major supporters of helping this V-shaped recovery happen, which is the Reserve Bank of India. The Reserve Bank has been going hand in hand, sometimes ahead of the government in terms of promoting an economic recovery with their accommodative stance. So they started with first a liquidity pumping. Almost 30% the RBI expanded its balance sheet, which about 8.5 lakh crores of liquidity. So there was no shortage of money supply. Second is the rates. By reducing the repo rates to extremely low levels, they have literally forced the banks to pass on the rate cuts. And this passing on, normally it happens in new loans because there is a competition to lend. So if you see on new loans from a level in Jan 2017 of about 9.75, it's dropped by 150 basis points to below 8, right? So that's today you see many banks are offering housing loans at rates as low as 6.5%. So clearly new loans have seen a dramatic fall. But the pleasant surprise is that even existing loans from close to 11% in Jan 2017 are down to 9.25% levels now. So almost more than 250 basis points drop, which this existing loan drop means straight away in terms of the stock market, it translates into a better EPS because the earnings goes down on their existing borrowings also. So that is the second helping hand that the RBI has extended. The third one was after giving two moratorias, the third one, they said no moratorium, but we'll restructure the loan so that they get a much longer period to pay back. So all decently rated companies, 66% of them benefited from the Kamath committee resolution, and that's something that has helped even the banks from an NPA perspective. So overall, these actions of RBI naturally have to be played out through the banking system. So hence, it's worthwhile to look at the banking system because a core part of the economy comes from the banking system. And so what we have seen here is the three highlights here on which I have slides which I'll show you. So the first is the COVID provisions, which was excess. The second is that the other provisions, systemic provisions also were excess. And third is that check bounce rates have also bouncing back. So that I will now show you in terms of this. So the excess provision buffer for each bank compared to what they thought was going to be the required provision and what actually turned out is varying between 50 to 150 basis points for various banks. So clearly banks overprovided. What is the benefit of this? The benefit of this is here, right? When those quarters when they over provisioned, their EPS came down, so markets became bearish on banking stocks. Today they have two choices. By writing back the provision, they can either boost their quarterly profit or boost their net worth so that their lending resources increases, right? So both from a pro-growth stance perspective as well as from the EPS management perspective, this earlier over-provisioning will come to the aid of banks in showing good results. That's number one. Number two is that if you look at it from a COVID provisions, right, and look at it on quarter, they all over provided initially and then brought it down. The only exception being Bandhan Bank because they had a more of a microfinance approach. So they had lowest borrowers of the very low marginal communities. So naturally they had to make a higher provision. But overall, you can see banks have brought down the COVID provision quarter on quarter, right? And I talked about overall provision on NPLs apart from COVID. Even there, when you see compare blue with red, that is September 20 with June, you can see that most banks are either stable or have dropped their provisioning, except SBI, which just increases provisioning to take care of the uncertainties, right? And talked about debit bounce rates, which is check bounces. As you can see, there's good news in terms of the volume and the value. Steadily check bounce rates have come down, indicating a healthier economic growth, which augurs well for the banking system. So overall, this leads us to have a fairly positive view of the banking stocks, right? So final 2 points. First is on the center's fiscal situation. This V-shaped recovery has also meant, and you saw the EA bill number. So with GST collections also going back above 1 lakh crore, we are seeing that the government's revenue receipts, right, and capex receipts have been far ahead of their projections. So overall, the fiscal situation is looking healthy. This is very important from an attractive foreign capital perspective because this impacts our rating, and that rating then decides how much money we will get. So a good, healthy fiscal based on the projections the government made at the present time, it looks like we'll be able to meet our budgetary projections of fiscal deficit. So that good news is overall a very positive from a foreign flow perspective for the economy. And then the other good news which has come up is that all these days, it was only government which was talking about infrastructure and investing in capex, and they were actually shouldering the capex burden of the economy for about almost 4 years now, from 2017 onwards. But the recent second wave bounce back has seen partly driven by an export demand from the developed countries and partly driven by a V-shaped bouncing demand. You're seeing that exports and these two have led to capex announcements, which means that the private sector feels that the existing capacities will not be sufficient a year or 2 years down the road. So they have announced the capexes. So that's an excellent news, especially for mid and small cap segment, because they are the ones who are going to supply cement, steel, capital goods, all of it to the private capex when it happens. And hence, from this perspective, if you look at it, right, this is an extra leg of growth for the economy, which will be boosted by certain structural factors, which I will come to later, right? Now, there's another way that we want to look at this, right? We are all interested in the future, right? Past data has a relevance up to a point, but what's going to come in the future based on their models. But there's another source. There is a source from the corporates in India who every quarter when they come with their earnings report are not only questioned about the earnings, what happened versus what was expected, but they also give their commentary on how they see their business in the coming quarters. So that commentary gives us an excellent clue as to how the future is going to turn out, in which segment is there positive, which sector is going to be less positive, and all of that. So what we observe from this quarterly commentaries is that the SME retail is started recovering. So large banks slippages are expected to ease, and NBFC's collection efficiency also is going to become broader. That's number one. Number two, we are seeing that discretionary consumption is going to be benefiting, and those kind of companies are expecting a strong pullback. The third is that they all expect urban India, which had the more severe lockdowns, to be faster in pickup than rural India. Right. The fourth thing is that as with the festive season and all households having excess savings because of the lockdown, they did not spend it. Part of it came into the equities market in terms of retail investors through demat accounts. Part of it came to mutual funds to increase SIP flows, and part of it is lying in savings bank accounts waiting to be spent. And that's where the auto industry is very, very optimistic about demand picking up. Those supply side semiconductor issues are still worrying them a little bit. Cement has witnessed a steady pickup in demand, partly because the government has continued to invest in infrastructure. And there will be a lull in cement because of the monsoon season. But after the monsoon, they expect it to again bounce back, right? So overall, the corporates are very happy about the second wave, the way we have handled it. Especially the healthcare sector is now expecting market growth to come from core therapies as opposed to just COVID-related treatments, right? And finally, on the IT industry, the confidence of the management around revenue growth is displayed, and they have strong pipelines of order books already there, and they see data analytics and artificial intelligence, right, as the new areas where they need people. And so there's a record pace of hiring going on in the IT industry, right? So overall, this corporate commentary gives you an extremely positive view for the economy in the coming months ahead, right? Now, this was a story for the next few quarters, let us say. But FIIs are not all short-term players. There are pension funds which look long-term. There are mutual funds in the domestic which look to a 3 to 5 year perspective. So then when you want to look at the threads, right, the structural positivity within the Indian economy for high growth, GDP growth, comes from three sectors, right? One is housing, one is PLI, one is national infrastructure pipeline. I'll briefly dwell on each. So first is the real estate cycle is now on the cusp of a turnaround. As you can see here, the real estate peaked around the 2016-17, after which it went into a recessionary trend, and now again the bounce back has started. This is very critical because it will be driven both by corporate real estate as well as housing. The all-time low rates in housing, surplus cash available with people, stamp duty reductions, and the fact that the RERA has introduced a level of confidence in the sector all augur well for the real estate cycle. And why it's important? Because real estate has two major factors going for it. First is that it boosts 10 to 12 industries. Because for every building that's made, there's cement, steel, electrical wiring, tiling, sanitary ware, paint, woodwork, all of these are needed, plus housing loan companies, right? All of these building materials, they get a boost. But more importantly, the real estate is also the largest employment generator. So government will also be consistently looking to boost it, because with an election approaching in 2024, it's the time to make sure that enough jobs are created in the economy, and the real estate is the one sector which can help that with the government perspective. So if you see here, the stock market listed players have already started benefiting. If you see, their share of the top 8 listed players has got tripled from 7% of the market in 2017 to 22%. So consolidation in that is also helping. So real estate cycle is clearly one of the structural drivers for the economy, which will get support from the government also, right? So already, if you look at it, there are two graphs here, two lines. One is the new launches of projects. Second is the new sales. It's one thing to launch, another thing to actually sell. Both of them have shown a V-shaped recovery post the COVID crisis. So real estate is clearly going to be a medium-term driver of the Indian economy. The next is the PLI. What is the PLI? It's a refashioned Make in India scheme. The Make in India was more about slogans. The production linked incentives is more about cash and hardcore action. What is the government doing? 5 to 6% of the value addition. You take raw material, add value, and then sell it either export or in India. That value addition component, government will give 5 to 6% for 5 years as cash incentives to the corporates. How does this help? So initially in the phase, it's hard for a company to start making profits from day one. There'll be a gestation period when they'll make losses, and then they'll make profits. This prevents them from really making much capital investment. But with this 5 to 6% contribution of government, they'll see their break-even point come much earlier, and the confidence to make larger capex investment will get jumped up. That's the thought process. The second thing is that the production link incentive is largely an export-oriented program. Why is that? Because the world, when it recovers, I talked about Asian exports in the first few slides, if you remember, right? So that Asian exports, China obviously dominates the whole export scene, right? But as you can see in a subsequent slide, people are beginning to move away from China. So there's something called a China plus one strategy, which is starting to play out, where India is well positioned to take advantage. And the PLI scheme is specifically meant to hit at those sectors where China is dominant, so that some shift away, we can take advantage. The other thing behind the PLI thing is the fact that most of these, since they are for export, many Indian manufacturers don't have that much capacity to make foreign quality goods and export them. So this program is actually to invite the foreign manufacturers to use India as a manufacturing destination instead of China, and re-export it, take it back out of India. So FDI flow will come in, which has its own advantages because it's permanent capital into the country. So how this plays out, I will now explain to you. So first of all, these are the initial sectors. Government goes on adding sectors. About $150 billion in sales and $70 billion in value addition is expected, and almost 1.6% contribution to the GDP will come from this value addition, right? Next is that the total investment needed is something like 2 lakh crores. So obviously that will have a spillover multiplier effect in the economy, in addition to which there is capital expenditure to set up these factories, which will be needed in the coming weeks and months, again auguring well for the cement, steel, building material, capital goods, mid and small cap companies, right? And as I talked about it, COVID has increased the relocation intent from foreigners, 44% of whom say COVID has increased their intention to relocate out of China. To do what? To set up fresh new production facilities outside mainland China. So that is where India is trying to pitch its hat and grab some of that business, right? And the beauty is it has already started making effect in terms of the kind of FDI we have started getting. You can see that black line graph, how sharply it is going up. Today, almost 3.3% of GDP is what we are getting. About $81.6 billion we got in the last financial year. But going forward, we should expect this to cross 100 to $150 billion based on the PLI-based inflows that we expect, right? And already, the effect of the fact that the government has reduced taxation for new manufacturing facilities to 17%, among the lowest, means that the FDI flows have already started before the PLI also. And hence, if you see from 2018 to 21, India is the second largest recipient of FDI, just below China and way above any of the other countries, right? So moving away from the PLI. So when the PLI scheme is there, it's not simply enough to just give those incentives. For a foreign manufacturer, when he comes and sets up a plant, he'll naturally set it up near to where the raw material or the labor supply is there, quality labor. But he'll have to export it from the port or the airport. Now, this distance to be covered, you need good quality highways, high-speed highways which can take the roads. We need waterways to be used. So the capital expenditure which the government had already been doing is what helped our ease of doing business improve. But the government in this 5-year period, 20 to 25, has set aside 111 lakh crore national infrastructure pipeline, focusing on energy, urban infra, roads, and railways, which will make the foreigners feel much more comfortable that they're not going to lose time and money on their products simply hanging around in the roads because of the congestion, right? So this infrastructure pipeline is meant to benefit the PLI scheme and meant to benefit FDI coming in, but in the course of building these roads and these airports and infrastructure, you're going to create demand again for capital goods and the capex cycle. So it will create its own booster to the Indian economy as a multiplier effect. So that's the NIP pipeline, right? And the government, how to finance this, has come up with a very innovative way where they don't sell their family silver. Instead, they give it on lease to the private sector for a certain amount of cash, and at the end of the period, that will come back to the asset. So, to control the opposition's allegations of selling off capital, selling off their family silver, the government has come up with this plan, which would help it generate cash. So, the initial plan itself talks about 6 lakh crores of inflows from the monetizing purpose. So, clearly, the government has a very well thought of process to how to generate the money needed to finance this infrastructure plan, right? So as a result of both the short-term bounce back and the longer-term structural play, we expect the India's GDP to go up by 1.4 trillion in the next 5 years. So where does it mean? It means that India will get about 5% of the incremental value add in the world, which is a very decent number, just behind the US, China, and the Eurozone. This 1.4 trillion will take our GDP from the current 2.7 in 2020 to 4.1 trillion. Mr. Modi, yes, he said that we should target 5 trillion by 2025. That's not going to happen because of COVID came and took us backseat for this whole thing. But 4.1 is the revised number which we can look at. And the significance of 4.1 comes from the fact that it will be higher than the United Kingdom, which is expected to be at 3.8. So very prestigious moment for India that somebody who ruled our country for 200 years, today we are overtaking them in terms of our GDP, right? So on that happy note of a very positive economic outlook, short term as well as medium term, let's move our attention to the markets, right? Now on the markets, right? So what is the factors which are moving the markets up and down? These are some of the factors I put in bubbles. The size of the bubble tells you the size of the impact on the market participants. So the biggest bubble is what's happening in America, US. The second biggest bubble is what's happening to global trade. The third biggest bubble is what the Fed going to do. There are other factors of much smaller importance vantage point. So looking at these factors now, you will see that the US, right, the Europe and Japan, these three account for 95% of the FII flows, but you can see the kind of balance sheet change they have done, right, which is what has ultimately trickled into FII flows into our market, is that in just the space of 1 year, they have expanded the balance sheet by 77%. RBI did it by 30%, remember. And they took 4 years to expand it by 80% in the previous crisis. So the speed of the action, the quantum of the action this time are much, much stronger. And that's the reason this liquidity has come and pushed up all kinds of markets, right? So this balance sheet growth, now there is talk of Fed tapering, but the Fed tapering that they talk about is just a very gentle reduction in this liquidity flow, right? So despite that, there's still an expectation of $29 trillion in liquidity floating around. They're going to start this by November, December, and by June, they would have finished the tapering. But the word taper itself tells you that it's a slow process. It is not a dramatic shift of pull out of liquidity. But yes, whatever said and done, a tapering will have its consequences. Of this 29 trillion, 9 trillion is from the US. As I said, the market is most focused on the US, right? And when you then look at it, right, generally, two things happen for FIFOs. First, there has to be liquidity. Second is the dollar should be weak. Then only people invest outside the US, because they not only want the returns from the growth of emerging markets, they also want returns from the currency appreciation against a weak dollar. Right? That's when money capital really flows out. Right? Now, what is the dollar strength based on? Dollar strength is based on the strength of the country, which is reflected in the deficits. So the current account deficit and the fiscal deficit. Now you can see that we have mapped both here. So if you see the combined deficit, when you map in the black line and you look at the dollar, which is the blue line, you can see that when the deficit goes up, the dollar goes down, and when the deficit goes down, the dollar goes up. So this liquidity tapering that they are going to do is going to be so gentle that we don't expect that the fiscal deficits or the current account deficits are going to improve in the short run. So dollar strength is unlikely. Hence, that's a positive for liquidity, whatever even is reduced liquidity, for it to flow outside the US in the hope of currency gains. Very often the word used for this is called carry trade, right? So that's one positive news as far as that. Until the day the US growth goes so strong that they see their deficits shrinking, then the story of dollar strength will come up, and that will have an impact on liquidity, right? The impact of this tapering, how can it affect the markets? If you want to look at it, I've compared here the 2013 time and now. And what's the difference? In 2013, I've shown here the current account, which is in yellow, and I've shown the core inflation, which is in blue. What can you observe? The current account surpluses are now much higher and the inflation is much lower, both of which give a very strong strength to the emerging countries to counter the impact of a tapering. So I think one important point is we cannot think that the kind of correction or whatever can happen will be anywhere close to 2013, because there is an inherent strength in emerging economies overall of current account surpluses and in low inflation, right? Moving to India, right? India has a third cushion apart from the story of current account and low inflation, which is true for all emerging and for India. India's forex reserve addition has been next only to China and way above the other countries, as you can see. So this forex reserve, right, what it has done is that it has now taken our forex level to about $650 billion. But it's what it's done is our import cover has improved to 14 months of imports. Why do I point this out? In the previous crisis, as you are aware, Mr. Raghuram Rajan was the RBI governor, because we had only 1.5 months import cover of reserves, right? There was a huge impact on the rupee, which went from 48 to 72, and he had to issue those NRI bonds to get money in at a very high cost of 4% fixed rate. So that scenario is unlikely now because of the kind of reserves we have and the kind of cover for imports that we have. So we don't have to worry about having enough dollars to pay for our imports. So this is the third reason. Current account deficit, one reason. In low inflation, the second reason. And the third reason is this, for not having the same kind of impact for tapering as was there in 2013, right? So as a result, you're seeing that FII flows have continued steadily come into India. In fact, if you look at it, compared to other emerging countries, Indonesia and India are the two ones which have consistently got positive flows, whereas other countries have seen periods of strong negative outflows as well as sometimes positive outflows. So we continue to stand out on that period basis. And in this slide, you can see for the last 3 years continuously, calendar year 19, 20, and the current year, we have got strong positive FII flows. And what has happened here is that last year, because of COVID, the mutual fund industry saw a net outflow of 56,000 crores. But this year, we're already seeing that about 6,000 crores of positive flows have come from mutual fund industry also. So the situation overall from a flow perspective, the market continues to be a strong story, right, for the factors I just mentioned. And naturally, this has meant that the Indian market for FIIs, I've compared here developed market stock market, I've compared the US stock market, emerging Asia, and overall emerging markets. If you look at it, India has outperformed all of the world markets. Why do I point this out? On the previous slide, you saw India is the one which got the maximum flows, right? So the country which got the maximum flows has also given the maximum returns. So we don't have any disappointed FIIs. They made a choice on India. It has rewarded them handsomely. So that level of confidence in India also continues continues to be prevalent, right? And in fact, this year, calendar year, if you look at all the markets, only the UAE, United Arab Emirates, has given a 29% return. India is second with 27% return, whereas many countries of the world have given negative returns to FIIs. So this recent performance of the Indian markets has given more confidence to FIIs to continue investing in India, right? And this investment is coming on the back of a sharp, the V-shaped recovery that we spoke a few slides ago is going to reflect in the Nifty EPS going from 540 for the last year to 732 for the current year and as much as 865. So this 26% CAGR in the Nifty EPS growth is what is making foreigners comfortable with the valuations of India. Though as domestic investors, we tend to think valuations are overvalued. We are taking a slightly longer term view of the economy's growth and not looking at trailing PE as many of us tend to do. Right? So quarter on quarter itself, the Nifty has reflected the impact of the second wave and then the bounce back. And again, I'm going to rely on what the corporates in their quarterly are talking about from their P&L perspective. That slide was about their economic outlook on the top line perspective. This is about the bottom line perspective. So first, the actual facts, the profits for the Nifty during the first quarter rose 102% YOY, right? So now for the future, the highlight, if you look at it, the fact is that supply side, metal prices rose, oil prices were a little stable. So their costs went up. So there was margin compression in the results generally. But since that margin compression came on the back of a surge in December 19, it is not a cause for worry. But what is the good news is from a commentary perspective is that these companies are now talking of taking price hikes. So that's the good news. Why? Especially across food products, paint, durable, auto, tires, we are seeing. So what this is telling you is that the pricing power is shifting from the consumer to the producer. When that happens, naturally, you can expect margins to expand and profits to rise faster than expectations, right? For this quarter, the earnings was led by commodities, exporters, and banks. And banking sector slippages were seen to rise for this particular quarter, whereas consumer-facing sectors face pressure. So that's a summary of the quarter gone by. But overall, the earnings growth witnessed signs of normalization, and the earnings beat increased in terms of the number of people who reported earnings better than the expectation. So overall, the corporate outlook also indicates that an economy on a revival mode means as demand revives, we will expect the margins also of corporate India to expand. So on that basis, let's turn our attention now to the large, mid, and small cap indices. Now, when you look at it break it into segments over the last 15 years, you will see that the Indian economy went through bull and bear phases. The markets also mimicked that. So when you now look at it, from December 17, the markets went on a down right up to the time COVID hit it. So December 17 to March was the last bear phase. And from March 20, the markets have been on a run. It's the bull phase. So here the interesting fact which I want to point out is that if you look purely at the bounce back from the COVID drop of March 20, it looks like small cap has performed the best at 200%, mid caps have risen by 150%, and large caps have risen by 120. So you'll say, mid and small caps have risen. A lot of people feel that they're overvalued because they have risen. But I would draw your attention to the fact that look at the previous quarter. The reason your small cap and mid cap have showing so sharp rises because they had equally sharp falls in the previous bear period. So December 17 to March 20, you see that small cap fell 50%, 54, mid cap fell 46, and large cap fell only 24. So because of that sharp fall, you are seeing this sharp rise. When you combine these two together, which is there in this slide, from December 17, I've compared large, mid, and small. What can you see? You can see that from December 17 to now, mid and small caps are underperforming large caps. So overall, if you take a longer 3-year perspective, you can see that the mid caps and the small caps are still not outperforming the large caps. And that's partly because FII support has been there for large caps, but it also tells you that for the future, as the Indian economy starts recovering, because when the good phases occur, which is phase 1, phase 3, and phase 5, you can see that when the economy is in a good phase, the small caps tend to outperform the mid caps, the mid cap outperform the large caps. So in this particular period, as based on the economic outlook that I have already given you, Indian economy in a recovery mode means the chances that the earnings growth of small caps and mid caps will far beat the large caps is a very real possibility, and hence this recent bounce shouldn't be seen as taking them too expensive. Take a slightly longer term view with a continuing bullish economic story. You will see that small and mid caps will continue to outperform, and also the fact that sectoral plays. I've taken here the various sectors in the stock market and each calendar year. You can see the red means a big negative and the pink means a positive, slightly positive. And if you track it across, you will see that year upon year, when you compare 1 year to the next year, it's very rare that the same sectors are outperforming or the same sectors are underperforming. So it's important to maintain a flexibility in our sectoral outlook. Most flexi cap and multi cap funds not only play across the cap curve, they also play across sectors, but that's the thing which is going to deliver results. So last 2 years, if you take 2020, pharma and healthcare, IT were the two top performing indices, whereas this year it's metals and power and utilities which are the best performing. So all the well in August for us to have a multi-cap, multi-sector approach to our investment style. And now when you look at what will do well in the coming years, you will see that the domestic economic growth will mean that realty, which has not performed well, will take a lead, as I pointed out. And then you have metals based on the demand for steel and ferrous metals. You will see a rise there. Consumer discretionary will show up in the BSE Consumer Durable Index being performed. So you have to keep a rapidly changing sectoral outlook if you really want to outperform in the markets. So a quick summary of all the slides that I've put. So I will skip, I'll just quickly touch them because most of the points I've touched, but in case 1 or 2 points are missed, it's useful to reinforce that. So the first point here, in fact, is one where I wanted to stress on. So while this tapering talk is going on, and yesterday's conference also indicated that we'll start by November, December and end it by June or tapering, but the fact is that they are delinking the tapering from a rate hike this time. That's a very significant thing which we need to remember. So rate hikes, they are talking about 2023. Why this is important? From 2 factors, right? It is rate hikes which makes the cost of money for hedge funds to go up and they try to pull out money. As long as rates remain near to zero, they will continue to have cheap money to bet on India or other emerging countries. Number 1. Number 2, any rate hike means RBI also has to hike rates, which means RBI's supportive stance will take a little bit of a beating. So because of this rate hike fear now going into 2023, it gives RBI that much more breathing space to continue its accommodative stance and support the government on the recovery path. So that's a key takeaway from the summary that I want to point out. The second point I think we covered, India has a much stronger external balance and contained fiscal alongside a strong forex reserve to weather any uncertainties. The third point also we covered, that we see a much more muted third wave of infections. The fourth point also we covered in terms of single dose and double dose vaccination and the seroprevalence survey. Then the fifth point of the agri and the frequency indicators also we spoke. Exports, as we said, was in a tear and global commodity space remains conducive. An extra layer of growth can come to the India story. We already talked about private capex announcements in earnings, and we also saw that inflation is likely to remain contained. So on the basis of this well-entrenched globally synchronous recovery, for the portfolio strategy, right, obviously our philosophy of car growth at a reasonable price remains. But if you look at it, portfolio positioning is largely 1, investment cycle resurgence due to the PLI and the structural things, and 2, a secular consumption on the back of a festival-based bounce back, especially in discretionary consumption. So the domestic growth recovery, we are playing it at Sundaram through an increasing exposure to quality financials, to consumer discretionary stocks, building materials, auto and industrials. And the global recovery story, we are trying to play that through metals, specialty chemicals, auto ancillaries and IT services. So these are the key components. Another strong component is IT, because we believe that Indian IT companies across large, mid and small are all benefiting from this multi-year cloud migration. As you know, people are going away from storing on their hardware to storing on the cloud. And so their software and everything needs to be changed to take this into factor. That's number 1. Second is the digital transformation. This means plenty of business for lots of companies in India across the cap curve, right? But finally, this big move of liquidity coming and playing has been done. That's called the large macro trade. But now stock selection will increasingly get more important as domestic economy recovery dominates the thought processes. And so we expect rising participation by mid and small caps, given the vastly improved economic environment. Right? With that, I come to the end of my presentation. Thank you for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.